Why bonds? I get this all the time, specifically for a 30-something MD like me, only a year out of training. Why should I put any of my 401k and other investment money into bonds as opposed to investing only in equities and a smaller amount in real estate? I understand bonds have much lower risk, and every book I've read recommends a minimum of 10% of bonds for anyone. Might be a reason for that. But since I don't plan on touching any of these funds until retirement, it could be reasonable to invest no money in bonds for now, and then add that to my portfolio maybe 10 years in the future. While this would be a relatively aggressive investment strategy, it seems that I could tolerate any changes in the total stock market over the next 10 years before I made my portfolio more conservative by adding bonds. Maybe you can tolerate it. Maybe you can't. How do you have any idea? You've never invested in a bear market. You've never invested and lost a substantial sum of money that used to be yours. Investing is not always an intellectual experience like you think it is when you read your first investment book and before you start hemorrhaging money in a bear market. But when you've lost a year's contribution to your retirement accounts or 2 years' contribution, money that you could have used for a kitchen renovation, money that you could have used for a new Tesla, you start thinking, wow, why did I put that in there when I could have enjoyed it? You see, losing money is not always an intellectual experience. It can often be a very visceral, emotional experience. And bonds help you endure through that. So I would caution anybody who thinks that 100% stocks is right for you to wait until you've been through a bear market to find out. One will be along shortly. It won't take that long. They happen every now and then. On average, they happen a couple of times a decade. And so you shouldn't have to wait very many years. You won't lose that much money by not being 100% stocks between now and your first bear market. And then you can know how you really react to losing money. And I remember in 2008, I was about 75% stock and 25% bond. And by the time that whole thing was over, that felt about right to me. To be quite honest, despite everything I'd read, despite all the time I'd spent studying financial markets, so on and so forth, I'm not sure if I could have tolerated a 100% stock portfolio during that bear market. I didn't have to find out. But in a lot of ways, deciding how much or what your stock to bond ratio should be is a little bit like the Price is Right. You want to get as close to the price as you can without going over, because the effect of having a little bit too little stock in there isn't that big a deal. But having a little too much is huge. That's a financial catastrophe, especially if you bail out of stocks at mid-career or later in the middle of a bear market. So the first reason to own bonds is just to help you tolerate the losses and the volatility in the stock market. And don't underestimate the importance of that. Benjamin Graham said, never hold more than 75% stocks or less than 25% stocks. And I think there's a lot of wisdom there. Obviously, some people disagree, but I hope most of those have actually had some personal experience in a bear market. The second reason to own bonds is it's entirely possible that stocks do not outperform bonds over a very long period of time. Now, it doesn't happen that that period of time has been longer than 20 years, but 20 years is a long time. I mean, look at me, right? It's 2018. I got out of residency in 2006. It's only been 12 years. There have been plenty of periods of time where bonds have outperformed stocks over 12 years. And so you need to realize that the long term for stocks might be a very long time, might be longer than you have, might be most of your career. And so realize that there's a reason that most investing experts recommend you hold some bonds. You can always ditch them later. If you get into your first bear market and you're like, this is easy, this is no big deal, then sure, ramp up the risk, go ahead. In fact, that'll be a great opportunity for you to buy low. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.